fundsupermart.com.
Hello everyone, with us today is Jeremy Friesen, Director and Commodity Strategist at SG Corporate and Investment Banking. He will share with us his outlook on the commodity market. What is the implication of QE3 to the commodity market in general?
Well, I guess there's two main effects. One is kind of just a nominal effect. One is fundamental effect. The QE is intended to improve growth in the U.S. economy and bring down unemployment. So to the extent that it actually can engender better growth, that's positive for commodities, as commodities would be used to in just the general workings of a stronger economy. Then there's also the effect of the nominal boost to commodity prices through its effect on trade. If the U.S. is the only one doing a QE program, then it's effectively oversupplying the U.S. dollar versus other currencies, and it's should be a bearish driver for U.S. dollar. And to the extent that commodities are priced in U.S. dollars, it's bullish for those. There's also the inflationary aspect of it, which is longer-term bullish. I think this is QE3 or QE Unlimited. The first QE programs probably had more of an effect on the real economy, and such had more of both effects, both the nominal and both the real fundamental driver. As we move to QE3, it's become much less of an efficient way or effective way of boosting growth. Clearly, the U.S. economy needs to have fiscal reform and other policy changes, not just monetary. But the nominal effect should still be there. We have only seen partial nominal effects. You saw certainly the sentiment up until the announcement of QE3 was very bullish for metals and precious metals especially, and a little bit to energy. That sentiment could continue to be there, and I think that actually other, not just the U.S., but other countries, other central banks that do quantitative easing, whether it be the Bank of England, Bank of Japan, to the extent that they're printing out more money, devaluing currencies, that should be bullish. But the initial sugar rush, if you will, of the announcement of QE3 was only seen for maybe a month or so, and it gets back to its less of an effect on the real economy, and the dollar effect was very short-lived. And that's unfortunately because the U.S. dollar has become or still is the barometer of global risk, and we're still in a highly uncertain period. Whether that be the U.S. economy with the fiscal cliff approaching at the end of the year, or the Eurozone troubles, or even with emerging markets with some uncertainty with China's growth. So uncertainty generally has supported demand for U.S. dollar assets. So the nominal effect of devaluing the U.S. dollar hasn't really been there yet. The QE program is likely to continue for quite some time, especially given our view and the market's view of slow U.S. growth. At some point, as uncertainties, whether that be the uncertainty with the fiscal cliff in the U.S. or whatever new administration takes over, if they remove some of the economic risks in the Eurozone should continue to improve and fall, and uncertainty with China with its new leadership, and those kind of things should reduce the investor interest in the U.S. dollar just as a safe haven, and it becomes less of that barometer of risk. And if the QE is still being pumped out and the Fed is still buying significant securities every month, and that should eventually weaken the U.S. dollar especially against emerging market currencies. And that's, I think, another big nominal driver for commodities. And that should be broad-based. Within commodities, I think precious metals is the quickest usually to react. It's a currency, so it effectively reacts like a currency in these kind of environments. Metals reacted quite sharply. In other agriculture and some of these other commodities tend to be more driven by their own idiosyncratic factors, such as weather, and that being the biggest one. And oil also has its own idiosyncratic factors on the supply side with geopolitics and sometimes weather-related disruptions. We're going through a storm in the U.S. right now, and that's probably going to take out some refineries, so that should be weakening for demand, oil demand, so that can affect price. So different commodities should have different timing as far as the response, but generally speaking, more money that's pumped out should broadly be inflationary for commodities.
What are the driving forces of agricultural commodities so far this year? Do these factors still remain?
Sure. Well, agriculture commodities are the most driven by the supply. Demand tends to be fairly, at least on a month-to-month and even year-on-year basis, it's more stable, and it's really the supply weather-related that drives agriculture. Unfortunately, we went through 12 months of really significant La Nina episode in the Pacific, which affected the crops early in the year in South America. And the main crop there is soybeans, and affected the U.S. crop. The main crop is soybeans and corn. So those were the most affected, and we saw record prices in soybeans and very high prices in corn. We hope that weather is stabilizing, and it's, you know, the 12 months of La Nina have come off, and we're at a more balanced weather episode with respect to the ENSO Southern Oscillation. So as the market starts to look more at the upcoming South American harvest, they should be a little bit more confident that supply will come on, especially given elevated prices. There's an incentive for farmers, should be very profitable. So that should incentivize higher supply. So if weather permits, through the next 12 months, we should see a building of these kind of inventories. Other agriculture commodities, rice, wheat was somewhat in the middle, not as affected, but the demand, there's some substitution with corn and soybeans through feed that has lifted wheat prices. But if you look at more of the tropicals like sugar and cotton and cocoa and coffee and palm oil, they've been less affected because they've been their production is in different parts of the globe, and so they didn't have the same weather problems. They're probably more affected by the global growth, which is probably at its bottom, we hope, right now, and so the trend or the cycle is different in the grain and oilseeds versus the other commodities or the other agriculture commodities, and they're probably at a bottom. We think that they may not necessarily pick up immediately, because our view is that we see kind of sluggish growth, especially with the U.S. and Europe with some headwinds this year and into 2013, and China likely to continue kind of a slow transition from one growth model to another. But that said, those are other agriculture commodities which have risks on the supply side, and if they materialize, it's usually going to be more bullish than bearish. And if you have the demand improving, you should see higher prices. So I think you have kind of two sides: the oil and the soybeans and corn and wheat. Probably will continue to moderate over the next few months and as we move into the next year, assuming weather holds. And the other commodities, other agriculture commodities, should see some more support.
It's now still a good time to invest in the agricultural sector. What is the upside potential?
Well, it depends on what you're looking for. You know, I think commodities, the asset class, is a good part of the portfolio and helps diversification. If you're looking at an agriculture, and agriculture obviously plays into the fact that the global economy continues to grow as far as population and as far as income. Both are important drivers of agriculture demand, food demand, and that is going to continue, and arable land per capita continues to weaken. Water issues become increasingly important. I think in the U.S. are going to become critically important over the next few decades. So I think there's good reason to be exposed to this space in some form. The commodities side and the equity side are different. And maybe holding them together is a good diversification as well, because if you're a farmer, if you hold land equity, or if you're a producer of meat products, for example, you'll respond much differently to the kind of shocks that agriculture gets. A weather shock, if you're the farmer that has the weather, that's very bad, but if you're a farmer next door, it's very good because the price goes up and you benefit. If you're a consumer, if you're a food processor, so you're really a consumer of some of these commodities, then it's bad when prices go up, but it's good when prices come down. So they can balance each other off, and holding an equity with a little bit of commodity exposure can help avoid some of the dramatic turns that are driven by unexpected weather events.
Is there any significant risk factors investors should bear in mind if they invest in the agricultural sector now?
Yeah, absolutely. You know, I think it's more volatile than, especially, you know, there's a lot of equities that are very volatile, but you don't hold a large share of just those. They're within a basket of other equities. The same with commodities. They should be within a basket of other securities, and hopefully that they're designed so that they offset each other and they complement each other. So if you're holding too much of one thing, if you're being speculative about something, then you should understand it very well. If you're using it as a way of diversification, then you should hold it in an appropriate amount and in the right types of commodities.